Hi, great to see you again. Frank McLaughlin here with three more tax strategies to disinherit Uncle Sam. In other words, three ways to legally pay less in taxes and keep more in your pocket and in the pocket of your family members. Now, I did cover three strategies last week, so if you missed that video, make sure to go check it out, and I'll get into three more for today, starting with effectively managing your RSUs. Now, if you're lucky enough to receive restricted stock units from your company, that's wonderful. They're a tremendous benefit, but there are some things to understand. Now, when those RSUs vest, they're going to be taxed as income to you. So you want to confirm that there's a tax withholding in place to avoid any surprises when it comes time to file. Now, the default is usually around 22%. You will want to check that. If you're in a higher tax bracket, make sure you bump that amount up. Now, where the planning really comes into place is after that vest, because any additional growth is going to be viewed as either a short-term or long-term capital gain. So putting in some strategies to minimize what you're going to have to pay on those. First strategy is looking at neutralizing gains with losses. Another way is thinking about taxes now versus in the future. Will you be making more in the future and thus increase your tax bracket? Or do you feel that we're headed towards higher tax brackets, maybe higher capital gains rates, as the government looks to deal with current national debt situation? And then another consideration is diversification. That's more in the realm of investments, a little bit less in taxes, but it's important. You don't just want to avoid paying taxes at the detriment of growth, risk, and return in your investment portfolio. So a lot of considerations there. We're well versed in this area, so if you have questions about RSUs, please reach out. I'm here and happy to help. The next strategy is asset location, taking advantage of the tax pros of different types of accounts and minimizing the tax drawbacks. So really the big three would be, let's say, an IRA, a Roth, and a taxable or non-retirement account. Now, instead of just finding the best 9 funds for your situation, let's add another layer to that. And let's get real strategic with where we hold each of those funds. Now, a taxable account is great for the flexibility of being able to withdraw funds when you need them, add funds without really any rules and restrictions there. But any income that the funds generate each year, you're going to have to pay. Whereas income generated in a tax-deferred account, you're not going to have to worry about that until it comes time to withdraw those funds. So if maybe tax-free municipal bonds make sense for your situation, look at holding those in your taxable account. Whereas a fund that may be great for diversification, such as a REIT or a real estate fund, but maybe shoots off a lot of income, look at holding that in your tax-deferred account. And then with the Roth, we want to hold our growth-oriented funds there, maybe a bit more higher risk, higher return, because any additional growth is going to be tax-free to you. And so just getting real strategic with where you place each fund can add just a little bit, even 0.25%, 0.5% each year, which really adds up over the long run. And then my third point here is explore donating appreciated assets to charity. If supporting causes is important to you, this is a great way to reduce your tax bill while also supporting a foundation or an organization that you value. So with capital gains, you're able to donate those funds. So instead of paying 15, 20% on capital gains that you have built up, you can look at giving those funds to an organization and avoid paying that tax bill at all. And so, these three strategies I covered today, they're for anyone, but they don't apply to everyone. So if you have questions on if they'll work for you, reach out. I'm here and happy to